Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are starting off this week once again on a fairly weak footing for the US equity markets. Arguably, this time more weak than any of the other times we've spoken about this over the last 4 or 5 weeks now. Largely the S&P 500 since November has been trading sideways. But this is really the first time, um, even though it's not technically the first time, but in the last few weeks, where a test of 5,800 or 5,850 have seen some meaningful test of that support level on some strong volume, which risks a potential breakdown below that $5,800 level on the S&P 500. If we look at this chart perspective, you have the 50-day moving average, which is now acting as resistance over the past, call it 5 trading sessions, as opposed to providing support. So we've seen a shift in terms of momentum from that perspective. Um, the rally on Friday, which was on the back of the cooler than expected inflation print, was the potential for the bulls to try to regain back control. But we swiftly lost control yesterday on the news of President Trump rolling out the tariffs for both Canada and Mexico, and at the same time doubling the tariffs that he had already rolled out for China, going from 10% to 20%. And just the speed and relatively uncertainty of all of that happening in a short period of time, where there was effectively no room for negotiations with Canada, Mexico, and China before these tariffs went into place, is part of what spooked a lot of investors right now and caused the sell-off we had here yesterday. We're now testing this major support level, which at the moment has a very high risk of breaking back below those levels. And a breakdown below those levels starts to target some significant levels here to the downside. You have the first kind of level, which is around this breakout level. This 5,700 would be our initial downside target. But, that's if that breaks, we're really looking at closer to 5,000 as kind of your next level here to the downside. So, the risks here to equities, I think, is currently sizable. If you look at the S&P 500, if you look at the NASDAQ 100, we've already broken below the prior support level at 500, which would start putting us back into the 450, 440 range here to the downside as far as the next target. The NASDAQ 100 underperforming the S&P 500. You have the Russell breaking below that 217 and a half as of last week, risking some further downside here as it underperforms the S&P 500. And you also have the equal weight S&P 500 breaking back below the 50-day moving average. So across the board, no matter how you slice and dice the US equity markets, things look weak, if not downright uh, uh, um, bearish on the US equity markets. So that's probably a pretty significant change from what we have been seeing here in the markets over the past few weeks. We've been talking about a deterioration in the overall quality of the U.S. equity markets, but this week marks a pretty significant pivot towards bearishness here for U.S. equities. We continue to see the value outperform growth in this current environment. While commodities continue to decline, mostly on the pullback here in terms of gold that we've seen. Interesting to note is that commodities, especially high yield corporate bonds, so far has not flinched with regards to any of the geopolitical stuff that's going on and tariffs. We continue to see a straight to the right grind here for HYG, high yield corporate bonds. This is interesting because bonds has sparked a rally here. Call it a bit of a flight to safety and customers buying safe haven assets. have driven bonds to a fairly significant bullish state, which leads us to have lower rates, which is overall supportive here for equities. So we'll see kind of how that plays out, that specific dynamic. But so far, the bond market not really flinching at the moment. You have the VIX trading back up to that 22% level here, suggesting that implied volatility remains incredibly elevated here over the next 30 days, or expected implied volatility over the next 30 days looks quite elevated here, especially when you have the S&P 500 testing major support levels, the Nasdaq already breaking below support levels. When you see the VIX at these specific levels, there's certainly higher risks of further pullbacks at the moment. We see this decline in yields. You see the 10-year yield is now below 4.2%. So that's a pretty significant shift in terms of direction, considering just a few weeks ago we're pushing 4.7, 4.8. So the fact that now we're back below 4.2 is generally a good sign for call it corporates, even treasuries, as well as consumers, where consumer debt has been on the rise, or just overall debt has been on the rise for corporations, retail, treasuries, and we see what the president is currently trying to do in terms of rein in spending for the federal government to try to bring down the net interest payments here for the U.S. But consumers and corporates fall into the same category. We've seen a record amount of debt being issued across both of those categories, and if interest rates don't decline, similarly to the treasury market, interest payments start to take up a larger and larger percentage of people's disposable income, which would certainly hinder their ability to spend, which is the primary driver of the US economy. So we have to keep a very close eye here on this. But so far, we've got an environment that's been supportive here for bonds, this kind of flight to quality, flight to safety, and it's flying all into bonds. You have the dollar index now below 107 on the back of lower yields here for the US dollar, driving a weaker dollar here. We also have Bitcoin, despite what was an initial positive reaction to the strategic fund for that President Trump announced. We find Bitcoin back at 83,000 to the downside, and this again warrants um, some caution as we break below. If we break down below 83, there's some further substantial downside risks, even in digital assets like Bitcoin. We have seen gold sort of not quite reach that $2,800 level, bouncing off a little bit here, but oil kind of breaking down back below towards that $68, $67 52-week low. Um, Oil prices so far remaining fairly stuck. We do have OPEC nations coming up to vote for a cut in supply and reduce the amount of flow of oil to stabilize oil prices, as oil prices so far this year have continued to slide as overall outlook and overall sentiment data remains somewhat muted at the moment. So then looking at sector rotation, this is really where we've seen a sort of lack of rotation to many degrees. What we've seen is technology take a very substantial loss relative to the S&P 500 just in the last few weeks. This is concerning here for kind of a risk-on environment. We also have um, a decline here in terms of the consumer discretionary sector as well. And on the flip side, we've gotten a continuation into more defensive sectors like communications, financials, as well as healthcare. Those are kind of consumer staples as well as healthcare. We've seen a pretty significant reversal in terms of the overall shift in terms of direction for those specific sectors. Hold on one second. I think the most important thing to recognize at the moment is the fact that we've seen this pretty significant shift in terms of sector rotation away from cyclical sectors into much more defensive sectors at the moment, which the fact that we're still seeing flow into the more defensive sectors, in my opinion, is a relatively good thing for investors who are concerned that this is going to play out into a bigger pullback here in the US equity markets. Because typically, when we see big sell-offs here, you do see outflows across all sectors, not outflows from the strong sectors into more defensive sectors. So, what we're seeing right now is more of a sector rotation, a bit more of a consolidation type um, price action here for the S&P 500. Now that obviously can continue to turn here, but if you look at kind of the price action here for the more defensive sectors, look at financials, look at communications, um, we're still seeing flows into some of those sectors, which is a relatively positive thing here for equities. We still see flows here into real estate, utilities. And the big thing I think is really home builders. As interest rates continue to decline, home builders have sold off so heavily here that could be starting to show some signs of a early bottoming signal where we could start to see some of these sectors turn around a little bit here. So, overall, things are looking fairly weak. But if you look at the market internals, at the moment, at least not yet, do I see enough evidence to point us to a big sell-off here for US equities? If anything, I see more consolidation, more sideways price action. I do think that there's very much likely that we will see some further downside here, but that further downside could lead to better prices to be purchasing equities at rather than being concerned that this is going to be a full-blown significant sell-off here for US equities. Now, like I said, that can change. So we'll continue to update you on this every single week. That's why we're here, is to make sure that you understand from a macro perspective how we're viewing the overall markets, and then more importantly, showing you some of the ideas that we have for the week. So let's take a look at some of the trade ideas that we're looking at here right now. The first one I want to take a look at here is Delta Airlines. We've seen all of the airlines rally significantly. Probably the most visible one is probably United Airlines, but I like Delta a little bit more to the short side. Basically what we've seen is the airlines, that have taken a very big move here over the last, call it 6 months or so since the summer. This was a $35 stock that effectively doubled in the last 6 months or so. The airlines have to some degree gotten a little bit ahead of itself, even though valuations for these stocks right now at the moment are not expensive. If anything, it was more that these valuations were too cheap back during the summer. So even though the fact that these airlines have rallied 100% in a relatively short period of time doesn't necessarily make it overvalued. It just, means from a technical perspective, things are a little bit overbought. As you can see, we clearly have made a higher high in price where we no longer confirm the higher high in terms of momentum, and we're starting to see some underperformance for these sectors. And I think the big thing here is really consumer spending and just generally speaking, consumer confidence. We've seen consumer confidence recently become quite poor. A lot of it has to do with the uncertainty around inflation, tariffs, geopolitical stuff. Consumers have recently turned quite concerned, even businesses. Um, and one of the big beneficiary of that explosion of consumer spending has been the travel related industry, hotels, airlines, which is why I'm looking at Delta because Delta trades at I would say a reasonable valuation, about 9 times forward earnings. But if you look at growth expectations, we've seen those come in quite a bit here for the airlines. Specifically, Delta's expected to grow slower than the industry median. And in terms of net margins, net margins of 5% are really thin margins for any company to operate on. Airlines are notorious for operating on razor thin margins. And this is really where I think that margin is at risk of some further compression if consumers pull back their spending, yet goods and services continue to be expensive, meaning inflation remains sticky. And that seemingly is the environment that we're in. So that certainly puts a squeeze on airlines like Delta Airlines, which is why in this market environment, I like potentially a short opportunity in the airlines. And my pick out of them is Delta. On the flip side, looking at Bank of America, this stock recently kind of traded a range bound between 43 and 48. It bounced off the lower end of that support level here. What we're looking for is continuation back towards 48 and potentially breaking out here. This is on the back of mostly a interest rate environment as well as a regulatory environment that looks more and more favorable towards these big banks. You have a yield curve that is no longer inverted. You have um, a regulatory environment that seems supportive here for equities. And that's why we will continue to maintain a bullish view here on some of the banks like Bank of America. On the flip side, the Chinese stocks that we've had a bullish view here on, I think we need to revisit some of those theses because of the recent tariffs in mind. So Baidu, PDD, Alibaba, these are all ones that we're going to put on review here for this week, and we're not going to add on to those. Looking at some of the oil services, Kinder Morgan, we maintain a bearish view here on stocks like Kinder Morgan. Um, Oil prices continue to be at rock bottom prices, and that's why we're going to maintain a bearish view here on stocks like Kinder Morgan. And then in this type of environment, I think the stocks to really look at are stocks like Visa that have net margins north of 55. So take a look at Visa. It's a great stock to own in your portfolio. It trades at a relatively high valuation, but a lot of these stocks that have net margins north of 55 are the ones that you want to pay attention to here in this type of environment. Hold on one second. Visa, as you can see, recently broke out again above this double top at 355. After breaking out above this 320 double top. We broke out of around 355 double top here again. So in this type of market environment, I think stocks like CME, stocks like Visa, that have net margins north of 55%, 50% are the ones that we want to continue to maintain in our portfolios. Those are the types of stocks that we're generally keeping an eye on here right now. Nvidia has taken a huge beating here over the last couple of days, but I think worth paying attention to because I still think Nvidia represents one of the best value plays in the markets here right now. We've obviously taken a big round trip here, bouncing off this 114 level, coming back to retest 114 as support. Nvidia now trades at about 26 times forward earnings. Um, y- y- you know, this is a stock that's expected to grow top and bottom line north of 30%. There are very few stocks that are expected to grow top and bottom line north of 30%. And on top of that, net margins are 55%. So the fact that it trades at 26 times forward earnings, which is cheaper than Meta, which is cheaper than Visa, which is cheaper than the only tech company that it's not cheaper than is Alphabet, but it's cheaper than any other tech company, yet it's expected to grow faster than any of the names that I've just named. It's more profitable than any of the companies I've just named, yet it trades at a valuation that is cheaper than any of the major tech companies. So for those reasons, I think that with NVIDIA revisiting 114 support is a potential reason to be a buyer here, especially as it reaches these support levels. The risk to reward ratio looks very favorable from my perspective because if you buy around these specific levels, one of the things is that if NVIDIA simply drops by a few more dollars, that's a good reason to say, okay, the entry level that I picked uh, was not optimal. Let me get out in terms of risking a relatively small amount of capital if you were wrong, versus the upside potential if you're correct is very substantial compared to the downside risk that you have with NVIDIA at these specific levels. So for those reasons, I still believe NVIDIA at the moment maintains one of the cheapest tech stocks that you can potentially purchase, given um, the multiple that it's trading at and the growth expectations that we expect out of NVIDIA versus the other tech companies. And on the flip side, if you look at stocks like Apple, Apple trades at 33 times forward earnings, yet it's expected to grow top and bottom line somewhere in the 8 to 10% range, versus 30% for NVIDIA. Its net margins are less than half of what NVIDIA's are, around 24, 25%. Yet it trades at 33 times forward earnings. So I think it actually currently represents one of the most overvalued tech companies at the moment. It's not expected to grow any faster than the average S&P 500 stock. It is a little bit more profitable than the average S&P 500 stock, but it trades at a multiple that is more than 50% premium to the average S&P 500 stock. And that's really where I think Apple represents one of the most overvalued stocks, while NVIDIA represents one of the most undervalued stocks in the markets here right now. Um, in the healthcare space, Amgen is one that we quite like, and we've seen that kind of flight to quality right now and flight to defensive sectors, and healthcare is certainly one of them. We had a recent breakout above 290, came back to retest this as support on earnings as the stock broke out higher here. Our upside target here is around 325, so we're starting to get there here. But in the more defensive sectors that are outperforming the markets, Amgen is one of our picks at the moment. Um, and lastly, um, Shopify. We continue to like Shopify here right now. It has been in the range bound mode here for the last 3 months or so. But as you can see, it continues to make higher highs and higher lows. It trades at a reasonable valuation given the growth expectations for Shopify are head and shoulders above the industry average, and it's more profitable than the average stock in its industry. So for those reasons, as long as it continues to make higher highs and higher lows, we continue to like Shopify for the long run. So that kind of covers what I wanted to share with you here today. Just a quick summary here. Equity markets are looking a lot weaker than they have been over the last, let's call it 4 or 5 weeks, where we've been talking about, equities starting to deteriorate. But, every single week, sort of towards the end of the week, we see a little bit more strength that shows that bulls maintain some level of control. But yesterday was really the first time I would say where we are a lot less confident in that. But the silver lining is that we've seen bonds continue to rally on the back of that, which lowers interest rates, which is certainly a bit of a tailwind for equities. And more importantly, we're seeing some sector rotation here right now. We talked about that last week. Sector rotation is healthy. Sector rotation provides the opportunity for markets to consolidate and trade sideways after a rally, to digest kind of that move, and then before it can continue to move on to the next bullish phase here. But we have to pay attention to some support levels recently that were broken on the equity markets, because if we break down further, there could be some further downside before we actually reach some support levels for buyers to step in. So that's where we stand at the moment. I think there are still opportunities on both sides of the market and both bullish and bearish ideas, but we certainly are shifting a little bit more to more bearish ideas here as the equity markets look a little weaker. But we'll be back here next week to update you on where we currently stand and new ideas that we have here for the week. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.